Let's dig deeper into the Fed decision with Wells Fargo Securities rate strategist Zach Griffiths, who's with us here in the studio. So, Zach, no surprises, right, on the actual decision. This debate, though, about asset inflation and the whole repo market operations has been quite interesting. Is there anything that stood out from the chairman's comments on that front to you?
You know, I think as far as what we're looking at, it was pretty consistent with our expectations. They had alluded to keeping purchases going and the repo market operations going through April in the December FOMC minutes. So to see that explicitly come out didn't surprise us too much. And as far as going past April, we think they're probably going to remain involved and maybe taper back the bill purchases, but not fully come out of the market from that perspective.
As we look at this repo market situation, what initially brought them into it, because they were worried about liquidity, and this is something most people, it's bank to bank overnight kind of situation. But then there are rumblings that there might be a bank out there which is in trouble because they've never explained in a way that most of us could understand why they needed to step back in. What you hear from your peers, is there a bank out there somewhere that's in trouble and that's why they're really in the repo market?
That's not what we're hearing, and I think it comes back to the fact that the Fed really wasn't sure what the ample or the cutoff between ample and scarce reserves was, and I think they just bumped up against that, and every indication that they had received from banks at that point was that they had room to keep reducing the balance sheet, but turns out that was not the case, and now they had to reverse course. And I think yesterday he referenced that they would like the lower bound of reserves to be $1.5 trillion going forward. So they'd like to bring it up so that regular fluctuations do not allow reserves to come below $1.5 trillion.
Hey, Zach, the Bank of England has decided not to cut. Anything we should take away from that?
Yeah, I think they decided not to cut, and they came out a little bit dovish, which is what we were looking for. And I think the bar is somewhat low for a cut at this point, but if the economic data holds up, and I think they're really going to be looking to what hard data they get in February, which will be the first hard data past the election, which seems to have brought at least a little bit more positive news, or at least seen more positively there. So I think they're going to wait till that date, I guess mid-February, and then from there we'll see what happens.
Julian, I want to bring you into this because between the Bank of England, even if they didn't cut, it's still pretty accommodative, right? The ECB accommodative, the Fed accommodative. Presumably you didn't hear anything yesterday that would lead us to believe that the stock rally is going to be disturbed by the Fed in any way.
No, if anything, from our point of view, it probably tilted slightly to the dovish side. Essentially, talking about April in terms of being there in the bill market and extending the repo, the Fed is saying we have got the markets back. Now, the question is, with all the other exogenous, sort of risk variables out here now, is that good enough for the stock market? In the last 24 hours, the answer is, well, it's an open question. But I'd like to ask, should we as investors actually be concerned about the Fed's management of short-term liquidity? And then as well, can we expect to hear something about the establishment of a standing repo facility later in the year?
So I think there's no reason to be concerned at this point, and we also think that it's unlikely the Fed will step away from active repo on a day-to-day basis without having a backstop facility in place. It's surprising how little we've heard from them as far as any details about how this facility would look, but we do think that's going to be part of their toolkit going forward, and that's going to be in place before they fully pull out of the repo market.
And that minuscule 5 basis point increase that they're going to pay on excess reserves, what they pay to the bank, how would you explain that to most people, what that truly means?
As far as what they did specifically, it's just geared towards bringing the Fed effective rate more toward the middle of their range. And it's really just a posturing thing to show that they have control over their main policy rate. And so bringing that higher through paying higher reserves or higher interest on reserves is really just a technical adjustment, and it's meant to put things well within their range, and that's really it.
All right, Zach, thanks. Zach Griffiths of Wells Fargo. Appreciate it.
Thank you.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.